Welcome to the Deep Dive. Today, we're digging into something that sounds super technical, maybe a bit dry, book tax differences in U.S. corporate accounting. But trust us, it actually has huge implications for how companies report profits, how they manage cash.
Absolutely.
So our mission today for you is really to cut through that complexity. We want to show why understanding this stuff is like a shortcut to really getting a company's financial health and its tax strategy. So what's the big deal for you, the listener?
Well, what's interesting here, it's not just, obscure accounting rules. It's really about two fundamental systems. They have different goals.
Okay.
And when these systems kind of collide, it creates these financial ripples. Understanding those helps you see past just the reported profit number.
Okay. Yeah, let's unpack that. Why even have these differences? Are accountants just making it complicated?
No, not quite. Fundamentally, companies in the U.S. have to follow two different sets of rules. There's financial accounting, that's U.S. GAAP.
Right, for investors and lenders.
Exactly. And then there's tax accounting, the Internal Revenue Code, or IRC. GAAP is all about transparency, showing the economic reality for those investors.
Makes sense.
But the IRC, its goal is different. It's about getting government revenue, first off, and also implementing public policy through the tax code.
Okay. So transparency versus taxation, that fundamental clash.
Yeah.
That's where the differences come from.
That's precisely it. The same exact transaction can end up being accounted for differently under each system because the goals are different.
Gotcha. So these differences, I'm guessing they're not all created equal. Are there different kinds we need to know about?
That's a really important question, yeah, because the lasting impact is quite different. We generally talk about two main types: permanent differences and temporary differences.
Okay, permanent and temporary. Let's start with permanent. What makes a difference permanent? Does it stick around forever?
Basically, yes. Permanent differences involve items that are recognized for booking profits for GAAP but never for tax, or maybe the other way around. They don't reverse over time.
Okay, an example.
Sure. Think about interest income from municipal bonds. For the company's financial books, that's income, plain and simple.
Right, yeah.
But under the tax code, the IRC, it's usually tax exempt. That difference is permanent. It lowers the company's tax bill forever relative to its book income.
Interesting. So that directly hits their effective tax rate.
Directly and permanently. On the flip side, things like, say, fines or penalties, those are an expense on the books.
Yeah, reduces profit.
But you can never deduct those for tax purposes, so that permanently increases their taxable income compared to their book profit, again affecting that effective tax rate.
Okay, so permanent differences change the rate. What about the other kind? Temporary, you said they're about timing?
Exactly. Temporary differences are all about when you recognize revenue or expenses. The timing is different between book and tax rules, but crucially, the total amount recognized over the long haul eventually matches up.
So it all evens out. In the end, it's just when it hits the books versus the tax return.
Precisely. And this is where we get into deferred tax assets, DTAs, and deferred tax liabilities, DTLs.
Okay, DTAs and DTLs.
These temporary differences create them. They don't change the total lifetime tax paid, but they absolutely dictate when the cash for taxes actually flows out the door. Huge impact on cash flow management.
Can you give a classic example?
Depreciation is the textbook one. Companies often use faster accelerated depreciation methods for tax. There's one called MACRS that's common.
Right, bigger deductions earlier.
Exactly. Bigger tax deductions now means less taxable income now. But for their financial statements, they might use a slower straight line method to smooth out earnings.
Okay.
That difference, recognizing more depreciation expense for tax now than for book, now creates a deferred tax liability. They're essentially delaying paying some tax.
So a DTL on the balance sheet means what? Future taxes owed?
Yep. It's a future tax obligation. The company paid less tax now because of temporary differences, but they'll have to pay more later when those differences reverse.
And a DTA, deferred tax asset.
That's the opposite. It's a future tax benefit. Maybe they paid tax early or they have a future deduction coming. It's like a prepayment or a receivable from the government in a way.
How are these actually calculated? Is it just the difference times the current tax rate?
Good question. No, and this is key. It's the cumulative temporary difference times the future enacted tax rate. The rate expected to be in effect when the difference reverses, not necessarily today's rate.
Wait, the future rate. So if tax laws change?
Bingo! A change in tax law can have immediate, sometimes massive effects. Remember the 2017 Tax Cuts and Jobs Act?
Yeah, big changes there. The corporate rate dropped a lot.
Right, from 35% down to 21%. Companies almost overnight had to revalue all their existing DTAs and DTLs using that new lower 21% rate.
Wow. So their net income could swing wildly.
By billions in some cases,
Yeah.
with absolutely zero change in their day-to-day business operations. It's a stark example of how political decisions flow directly onto financial statements.
That's fascinating. So managing these isn't just about following rules, it's strategic.
Oh, absolutely. It's a major strategic tool. Companies actively manage temporary differences to defer tax payments. It's like getting an interest-free loan from the government, you know?
Yeah.
Great for current cash flow.
And the permanent ones.
They manage those too, aiming to influence their effective tax rate because that's a number investors watch very closely.
And how does the IRS keep track of all this maneuvering?
For larger companies, there's a specific, pretty detailed form called Schedule M3. It basically forces them to reconcile their book income, line by line almost, to their taxable income. It provides that transparency back to the tax authorities.
Okay, so M3 is the bridge. It seems like deferring tax is generally a good thing for a company's cash right now.
Generally, yes.
But is there a point where maybe seeing huge DTLs build up year after year could be a concern for someone looking at the company, or is it always just smart planning?
That's actually a really good question for you, the listener, to think about. Because yes, deferral boosts cash now, but large or constantly growing DTLs do represent significant future cash outflows for taxes. It's definitely a trade-off to watch.
Right. So pulling this all together, this deep dive really shows that figuring out a company's tax situation from its financial reports isn't straightforward. It's this dynamic balancing act.
It really is. Between optimizing cash flow now, managing the earnings they report to the street, and just navigating some very complex regulations.
So the bottom line, profit number, it doesn't tell the whole tax story.
Not by a long shot. It doesn't always reflect the actual cash taxes being paid now or what obligations are building up for the future.
So maybe next time you look at a company's financials, look beyond that net income. See what their deferred tax liabilities are doing, or check out their effective tax rate. It might tell you something interesting about their cash flow reality or their tax strategy. So what stands out to you now about how these accounting quirks, these differences, really reveal the intricate financial dance companies perform? Hopefully this dive helps you ask even better questions.